We're a long way from full employment. We're a long way from the Fed's goal of 2% inflation. But you actually think that's a good thing for equities. Can you kind of explain your thesis?
Absolutely, Frank. The Fed has basically promised over several sessions now that they're going to continue to print money until they reach the dual mandate that you talked about, full employment, 2% inflation, and we're a long way from both of those things. So that's great for equity markets. I mean, in some ways, it's bad news is good news. Also, too, if you know, and of course that covers the monetary policy front. The jobs report on Friday was the worst we've seen since April of last year. And the same day, President-elect Biden called on Congress to provide more fiscal stimulus now, COVID stimulus. So we're kind of in a sweet spot of stimulus right now from both the fiscal and the monetary standpoints.
So you're unconcerned about the printing of money. What does concern you?
Well, you know, obviously from the standpoint of full employment, we're a long way from that. We may be a little closer to the 2% inflation than we thought. I think a couple weeks ago, most market analysts were thinking that we're a long way from that. But some of the recent reports are showing we might be closer to that. But I think it's probably a little premature to say that's in fact happening.
Okay. Well, speaking of forecasting, let's look ahead to financial earnings coming up this week. Financials, the best performer over the last month and number 2 over the last quarter or so. What are you expecting to see when banks do their earnings later this week? And what do you think could move the market higher, or what could move the markets lower?
Yeah, well, I think in regard to financials in particular, I think we're going to see some decent earnings, at least beating lowered estimates. And in fact, financials are one of my favorite sectors that I like going forward. And as far as the market as a whole, it seems like as I've already mentioned, we've got these double-barreled stimulus packages coming our way, not only from the Fed but also from the government. That should continue to provide an underpinning for earnings overall going forward. And I certainly wouldn't underweight stocks here. I'd market weight stocks.
Yeah, speaking of, you're overweight on large cap stocks and you're underweight on small cap stocks. So where are you bullish? And I'm a little surprised because the Russell over the last week, that's been the outperformer over all the indexes. And a lot of people see that as a recovery index. So are you anti-recovery? I mean, kind of give me a sense of what you're bullish on.
Well, so that call that you just mentioned there, liking large cap growth stocks over small cap value stocks, it's mainly related to interest rates, the dollar. The Fed's going to keep rates low. That should continue to pull, have some downward pressure on the dollar, and that's going to help big cap multinationals. So not anti-recovery. It's just more kind of the mathematics of it all, how it would play out, and then in regard to other areas where I'm bullish, I've already mentioned I like financials as far as the sector. Consumer staples and energy also look attractive here as well.
Yeah, we're seeing crude hit an 11th-month high here. Do you see energy continuing to have strong gains? And is that also tied to the recovery, or is that tied to industrial manufacturing picking back up again? I know we get the ISM later today.
Yeah, yes, ISM manufacturing out today, and I think as obviously with energy, we certainly saw a cratering of demand at the height of the pandemic, and perhaps we're at the height of the pandemic right now. Yeah, we should see demand pick up going forward.
Shepard Smith here. Thanks for watching CNBC on YouTube.